Today, we will follow Arthur's life and witness his journey to retirement at the age of 43. He retired at this age because he knew how to invest his money throughout his life. This reminded me of a question. Did you know that our retirement through the INSS, National Institute of Social Security, is a pyramid scheme, and that if you are under 30, you probably won't retire relying on the state? But that's a topic for another video. Let's get back to Arthur's story. At the age of 43, Arthur retired from his 9-to-5 job at an automobile factory. He achieved this freedom by combining efforts to save and invest in his investment portfolio in the financial market. Despite graduating from college with not a penny to his name, Arthur completed his university studies by the age of 23. Following in his father's footsteps in mechanical engineering, even before finishing college, they both joined the job at the vehicle assembly plant, an accomplishment applauded by his entire family. However, deep down, Arthur questioned, is this all there is? From the early weeks at the factory, this desire for something different from the routine strengthened. During a conversation with his supervisor, Raphael, a veteran displaying a golden watch from years of service, Arthur couldn't help but think, he's still here, performing the same tasks as when I was younger. It seemed like Raphael spent his days fulfilling responsibilities rather than pursuing his aspirations. Arthur noticed this during lunch, when Raphael only talked about fishing, nothing related to improvements on the assembly line. This pattern was also present in Arthur's father, who loved hiking, but could only do it once a month due to his busy work schedule. Interestingly, making money was costing them dearly. In this video, I intend to share 3 stages Arthur went through to achieve financial autonomy. You'll notice that different elements were relevant in each stage, but one element remained clear from the beginning. If Arthur hadn't invested, relying solely on his salary to reach his magical goal of $1 million, he would be telling this story at the age of 57, not 43. By investing, Arthur gained 14 years of life's most precious resource, time. I will present what Arthur focused on as an investor in the financial market, how he used the stock market, and what he prioritized outside the realm of investments. And, possibly more crucially, what he avoided doing. Before we continue, pay attention here. This year, 2024, is filled with great opportunities, and it's your chance to change your life. So, be an optimistic person and type in the comments, I will be rich in 2024. Just type that, I will be rich in 2024. When I see this comment, I'll know that you're someone who really wants to change your life, so I'll give a heart to your comment. Well, now that you've commented, let's continue. Phase 1. How Arthur went from $0 to $20,000. This represents the beginning of the journey. Some of you may have already surpassed this phase, and if so, congratulations. Stay tuned. We will soon address the phase you are currently in. On a regular day at the library, Arthur was sent by his mother to fetch a book for her. At that moment, he literally bumped into a copy of The Richest Man in Babylon. Yes, bumped into it while distracted, admiring a friendly red-haired attendant. Arthur dropped books on the floor. The cover of The Richest Man in Babylon suggested something like a sure path to happiness and prosperity. Maybe that's exactly what he needed. Arthur chose to borrow the book, even with the attendant still laughing at his clumsiness. What an embarrassing situation, and she was even more charming up close. Arthur secretly hoped to bump into her again. The book suggested that Arthur allocate 10% of his monthly salary before spending on any other expense. An intriguing concept, especially when compared to the habit of Raphael, Arthur's superior, who invested his money primarily in fishing equipment. Arthur began to notice that Raphael, in a way, wasn't compensating himself. Not that this was inappropriate, but it didn't seem to be the right approach to achieve financial autonomy. Compensating oneself initially was the right move at this early stage. The financial market is excellent for converting a reasonable amount of money into a substantial sum, but it's not as effective for small savings. Arthur learned this lesson the hard way after absorbing The Richest Man in Babylon. Later, he immersed himself in Robert Kiyosaki's work, Rich Dad, Poor Dad, and realized that these markets were environments where savings could turn into assets. The setback began when, with no prior investment experience, Arthur got carried away by speculative suggestions on social media and from some colleagues. Initially, everything was going well, with significant gains. $5,000 turned into $10,000 in a week. However, the outcome was predictable. With this strategy, the scarce capital he had rapidly decreased by 80%, leaving only $3,000. Arthur transitioned from the peak of Mount Stupid to the Valley of Despair on the Dunning-Kruger curve, even without knowing Warren Buffett at the time. He assimilated the golden rule number 1, never lose money, and luckily also internalized Buffett's second most crucial rule, never forget the first rule. Despite the notable percentage drops, Arthur managed to recover in 2 months, thanks to his salary. Unlike a colleague who had invested entirely in a new cryptocurrency, at least Arthur wasn't out of the game. However, he realized that dangers would increase as his investments grew, and mistakes would become more costly. Determined to change the situation, Arthur created a learning sponge. While having his meals, he followed his favorite financial influencers on YouTube. During his walks, he listened to his favorite podcasts. Gradually but decisively, Arthur emerged from the depths of the Valley of Despair. He managed to turn $0 into $20,000 in about 2 years, following this strategy and saving $100,000 from his monthly salary. In the second phase, Arthur went from $20,000 to $100,000. When Arthur entered his 3rd year in the automotive industry, his father wanted to have that talk. Arthur, his mother, and I were impressed with his savings efforts. How about we contribute an additional $10,000 and you buy your own house at first sight? This seemed like a luxury and a great opportunity, but it was far from that. It was a trap. Arthur still didn't know Charlie Munger, but Munger would say, "The first rule of compound interest is never interrupt it unnecessarily." Fortunately, Arthur was familiar with the words of Robert Kiyosaki, author of Rich Dad, Poor Dad, who stated, "A house is a liability. You need to acquire assets." With this wisdom in mind, Arthur politely declined the offer and chose to keep his money in his investments. The second stage is marked by the recognition that the financial sector can no longer be neglected. A significant portion of the $100,000 must come from the yields of these markets. Otherwise, you are overexerting yourself. It may be tempting to feel empowered by possessing some capital, as Arthur did, but it is crucial not to get carried away at this stage. Even though it is now possible to buy a vehicle in cash or consider using these funds for something more valuable, like a down payment for a house, moderation is necessary. Celebrating excessively can harm the effects of compound interest, which are now starting to gain momentum. At the age of 27, Arthur was deeply involved in the analysis of companies in the stock market. He vividly remembered the results of his speculations on tips from social media companies and colleagues that showed no profits a few years earlier. Now, he invested only in what he understood, not seeking brilliant or abundant investments, but following Buffett's maxim. "I don't look to jump over 7-foot bars. I look for 1-foot bars that I can step over." Arthur's phone rang. It was Raphael, the top student in Arthur's school, now graduated in economics from USP. "Arthur, I just found an incredible investment opportunity. It's a startup, something like the Amazon of the metaverse. Interesting. What is its net income?" Raphael: "Are you kidding me? Net income? It's a startup. Well, when we expect them to start making a profit, I don't know if that matters. We'll make a lot of money when they go public. I'm investing $50,000. How much do you want to contribute?" Arthur trusted Raphael. Even I admired him when it came to economics. However, this didn't seem to align with the ideas of those who achieved long-term success in the market. Would Peter Lynch have invested in this opportunity? Choose a business that any fool can run, because someday a fool probably will. It didn't seem like any individual could manage the Amazon of the metaverse. Okay, I'll start with a smaller contribution. I can put in $500. Raphael said, $500? You're weak. During this period, Arthur followed the advice of not being naive, as Charlie Munger used to say. Instead of venturing into things that seemed complex to him, Arthur chose to invest in stocks of companies that had shown consistent profits for at least 5 consecutive years. They held only common stocks, except for major banks like Bradesco and Itaú. In cases of initial public offerings, IPOs, only after 5 years, and with a track record of consistent profits. Recently, he also invested in shares of good real estate investment funds. He knew that making mistakes now would be more costly and could significantly delay his journey towards financial independence. Arthur kept his learning habit high, one day returning to the library to pick up a copy of Stocks for the Long Run by Jeremy Siegel. He didn't just bump into someone once but twice. First, into the girl. Second, because the girl was the same friendly redhead attendant. "You truly are clumsy, always falling on your knees," she teased. "Oh, does she really remember me?" Arthur wasn't sure if this was positive or negative, but the memory of how charming she was up close came flooding back. From that day on, he determined that reading is best done in the library, in tranquility and silence. Eventually, he gathered the courage to invite the young Sarah out. The chemistry was instant, sharing an interest in books and a low-spending lifestyle. Sometimes they took turns reading aloud to each other. These encounters were called read and relax, indicating that they didn't just read works on finance. Speaking of finances, while Sarah was an organized person, Arthur was not as systematic. This difference in style extended to spending, becoming our expenses when they decided to live together. This change ended up helping Arthur increase his savings rate. Sharing rent was cost-effective. At the same time, his responsibilities at the factory increased, and he was no longer considered a junior engineer. Arthur managed to raise his earnings from $1,000 to $1,500 per month during this period. Additionally, he achieved quite solid returns in his investment portfolio, averaging 10% per year. Together, these factors turned him into a holder of $100,000 on his 29th birthday. As expressed by Charlie Munger, the first $100,000 are challenging, but it is imperative to achieve them no matter the sacrifices necessary. Whether it's walking and cutting expenses, even with food, find a way to reach that goal. Later, it's possible to enjoy a certain relaxation. Arthur was excited to witness the autonomous expansion of the snowball. What he didn't realize was that he was about to face an almost 40% drop in his wealth in just 1 year. Phase 3, lose trajectory, zigzagging from $100 to $1 million. "Hey Arthur, are you hearing this?" It was Raphael calling. "No, I'm not listening. What's going on?" "It's the sound of my new Tesla, brand new. Incredibly silent, isn't it?" "Wow, yes, it's truly quiet." "Raphael, did you get promoted?" "No, it's about the startup. You know, Amazon Meta. They're going public." All right, this doesn't explain how Arthur became a millionaire, but this is how your friend Raphael achieved that feat. Amazon Meta gained a return of 2,400% when it went public, and Raphael was now a fortunate holder of $1,250,000. Arthur, who invested $500, only got $12,000. Even though the $12,000 were a bit less than what Arthur could save from his salary in a year, it stung a bit to know that he didn't invest a larger amount than $500. He tried to internalize Warren Buffett's mantra, half of all coin flippers will win their first toss. None of those winners has an expectation of profit if he continues to play the game. Because, after all, how could Raphael predict that Amazon Meta would bring such a significant return? He never showed specific interest in technology or anything related to Meta before. Arthur really questioned if Raphael would survive if he continued to play this game in the future. Arthur, now in his early 30s when it came to material things, was not alone in doing things differently from Raphael and Sarah. Practically everyone at work seemed to be outdoing themselves with their vehicles, their clothing, and their reservations at restaurants, basically showing no signs of moderate spending. I'm not saying that an expensive lifestyle is wrong, but make sure to understand the opportunity cost of your decisions. Once you open the door of your investment portfolio and let a sum of money out, can you close it again? Don't underestimate the power of habits. A part of Arthur ignored his colleagues' rather luxurious lifestyle and wanted to stay true to his own goal. Arthur remembered Raphael's advice. You don't want to be trapped in your job until you're 65. However, another part of him wanted to show his male colleagues that he too was a man of means, that he too was successful. After all, he couldn't exactly show them the numbers in his investment portfolio every day. That would be strange. He tried to remember something he heard in a YouTube video, something about wealth being something you don't see. When you spot someone driving around in their year-old Honda Civic, recognize that you are also witnessing someone who is a less fortunate Honda Civic owner. So is it worth it? Arthur appreciated the YouTube video, a true paradigm for all of us. An unforeseen event was about to change the game for Arthur in a surprising way. Just before turning 31, the financial market crashed, falling more than 50% over the year. Technically, this meant that Arthur regressed to stage 2, falling below $100,000. However, Arthur didn't let it shake him. He was prepared for this moment, mindful of Benjamin Graham's words. If you are buying common stocks, choose them in the same way you would buy groceries, not the way you would buy perfume. At that specific moment, there were discounts on all products on the shelves. Arthur realized it wasn't the time to spend money recklessly. It was the chance to pick up shares of notable companies that pessimists were trying to get rid of quickly, while he used to achieve returns above 10% per year in the markets in the 2 years following the crash. He achieved significant 30% and 45% returns, respectively, by the time he turned 33. Many changes occurred simultaneously. His portfolio now contributed more to his savings each year than his salary, maintaining fairly stable returns in the financial market, around 10%. At this point, with his daughter turning 10, Arthur and Sarah felt it was time to provide a more permanent home for the family and chose to buy a house. So, they bought a residence within their means, valued at $115,000, which he and Sarah shared now that they were married. The $57,500 represented a setback for Arthur's money-making machine. However, he remembered that even Warren Buffett spent 10% of his fortune on a house in 1958. Besides, he felt he had delayed the decision as much as possible. Upon turning 35, Arthur moved to a competing car manufacturer, attracted by a 20% higher salary offer for the same number of working hours. Despite the higher salary, the returns from his portfolio significantly outpaced his monthly income. In some months, however, he faced periods of lower revenues and investments than his basic needs, which generated some anxiety when patience and perseverance as a smart investor were tested to the maximum. Additional contributions did not have an immediate significant impact on the portfolio value, and Arthur needed to be cautious when projecting monthly returns for the future. Despite the difficulties, he remained true to his investment process. At the end of this stage, Arthur began to reignite his interest in photography, a long-forgotten hobby. He established a small-scale wedding photography business, envisioning an additional source of income that would eventually facilitate his transition to a life beyond conventional employment. Phase 4. Arthur's financial autonomy. Arthur reached the $1 million mark and left his daily job before turning 44. More than half of this amount came from market financial returns, allowing him to reach this milestone 14 years earlier than he would have with just his salary. With this amount, Arthur felt confident that market financial gains could contribute to his annual expenses, Now he dedicated more time to activities that truly made him happy, such as investing in the financial market, exploring trails, improving his photography skills, and most importantly, spending more time with his family and friends, being an even more present father. Currently, Arthur owns his own time, earning a considerable income while indulging in the things he loves. Excited about his new reality, he decides to call Raphael, an old acquaintance he hadn't been in touch with for some time, to share the good news. "Hi, Raphael, are you hearing this? Hi, Arthur. Long time no see. No, what is it? This is the sound of us not working on a Monday morning." For some reason, the joke didn't seem to please Raphael. Arthur tries to understand what's happening. "Arthur, do you remember Amazon's big success, Meta?" "Yes, well, I retired with that money. I know that, Raphael. So I took that capital and invested in a company called Starverse." "Oh, what a terrible name. Yes, I know, but they promised to be the Starbucks of the metaverse. Confident in them, however, things went wrong. My boss wasn't pleased when I asked to come back, but he agreed. Anyway, my retirement is still far from happening unless I discover a new Amazon Meta. Who knows?" What makes this narrative so remarkable? Well, perhaps nothing, and that's precisely what makes it so unique. Many of you have the ability to achieve more than Arthur, if you truly commit to it. While, for some, $1 million may be enough to achieve financial autonomy, others may need 5 or 10 million to ensure a comfortable passive income. It's possible that many of you can achieve even more significant returns in the financial market if you truly dedicate yourselves to it. The key message here is that if Arthur, an ordinary individual, meaning not a prodigy, managed to achieve financial autonomy, all of us can follow this path. If you're already in your 40s and still far from achieving financial autonomy, know that it's much more advantageous to achieve it at 65 than at 80. And the sooner we start, the simpler it will be to reach our financial goals. The video is ending, but our conversation continues down there in the comments. Don't forget to express your opinion, suggestion, or doubt. I'm signing off for now until next time.